Excellent. Well, welcome to today's panel. I personally believe that it's quite a good timing to be discussing this topic, particularly because we have been experienced a sustained bull market. And with this sustained bull market, we have seen the need for asset managers to refine their strategies and mature their portfolios. This sustained bull market has also driven substantial amount of inflows, and I'm pretty sure that we're going to have a very good conversation today. We have very insightful voices in the space, each of them with very diverse backgrounds, with their own perspectives from their own firms. And I would like to dive in right away. Before we start, a brief intro from each one of you on what do you do and what your firms do. Quentin, would you like to start?
Yeah, good afternoon, everyone. So I'm Quentin. I'm in charge of portfolio management within Six Monks. Six Monks is the first and today only alternative investment fund manager in Luxembourg who owns an authorization to handle a regulated crypto fund. So we're the first one to be in a position to have regulated crypto fund using a European passport, being able to distribute that across Europe.
Yeah, good afternoon. My name is Leinweber. I'm running our digital asset research at MarketVector Indexes. So we're coming from the TradFi space, but we developed our first digital asset indexes in 2017. So we're doing that for 8 years now and doing the whole suite of single token baskets, staking indexes. Yeah, happy to be here.
Hi, everybody. Giovanni Vicioso from CME Group, Global Head of Cryptocurrency Products. For those of you unfamiliar with CME Group, we are one of the oldest institutions. We've been in business for over 180 years, helping participants, both institutional and retail, across 6 different asset classes manage risk. We entered this space in 2016 with the introduction of a reference rate and followed that up with the introduction of tradable futures products in December 2017. We currently have 4 products in market. We have futures and options on futures on Bitcoin, Ether, and recently launched Solana, XRP, and XRP as well. We're trading upwards of about $10 billion a day, and in addition to those products, we also have a family of reference rates and real-time indices covering or soon to cover 28 different coins and tokens.
Good afternoon. My name is Paolo Guarnerio. I'm a co-founder and partner of Berglinde. We are a Swiss asset management firm based here in Zug, and we are focused on Bitcoin strategy. Specifically, we are very active in Bitcoin-backed lending.
Excellent. Thank you, Paolo, and wonderful intros. As you can see, each of them in a league by their own. The first question will be focused on TradFi investors, because those are the ones that have majorly shown interest in this bull market. And with that being said, I would like to ask each of you what the specific narratives or asset classes within the space have been more compelling to those TradFi investors. Monty, would you like to start, perhaps?
I can start on this one. So definitely, I would say that Bitcoin has been being the main asset is the first one that traditional finance players are looking at. We've seen it because it was discussed earlier in the panel. The altcoins are not following the same trends as Bitcoin in the last months. We have seen a little better in last weeks, but still. However, traditional finance players, they also like to see the same investment products they are using regularly. We have seen a tremendous trend with the ETF of BlackRock, and it's probably one of the best launch of ETF ever, and it's still continuing to attract investors, and most of those investors are not retail clients, are institutional. So we truly believe that the next shift is going to happen is toward a mutual fund and investment fund, because those funds have not yet deployed a lot in crypto, and many actors are waiting this fund to be in a position to deploy, because for instance, if we take an example of a pension fund or an insurance company, their investments are always toward mutual funds. It's very rare they access the asset directly, and that's what we see at Six Time.
Excellent.
Yeah, for me, it's also the store of value narrative, but it's less about Bitcoin because Bitcoin didn't change. It's really about what happened to bonds. And as a former bond portfolio manager, I'm really worried about the long end of the US curve, because I think the US lost control about it. And what we see at the moment, and I don't mean the Elon and Trump debacle we have at the moment, it's really the deficit is out of control. And people are flocking to store of value assets. Yeah, you see that with gold, but you saw yesterday a breakout of silver. You see a breakout of platinum, and that's not a coincidence, right? And so I think I'm finally happy that Bitcoin diverged, yeah, since Liberation Day, because it was always the Nasdaq on steroids thing. Now it's really, it established itself as a store of value. And the beautiful thing about Bitcoin is that you can trade it spot, you can trade the futures, the options, you have the strategy companies, the treasury companies, sorry, you have the mining companies, so we have a different flavor for everybody here. And I think that makes it super attractive. Now I think also that over time, that this whole development helps the whole crypto space, yeah, because I think the old system is deflating and the new system is inflating, and so that makes me long-term bullish. That's also not a one-day, one-year thing. Yeah, the US dollar is too large for that, but it's really a long, sustainable shift I see from diversifying out of dollar assets into crypto and international assets as well.
Yeah, I mean, I think that we're really seeing a new era for crypto, right? And I'd say one that's characterized by just growing maturity, considering that Bitcoin's been around now since 2009, and just seeing the growth, to Martin's point, this year. But we're also seeing increased adoption, and that adoption is coming both, say, from institutions. We're also seeing retail, in the space as well. And I think another thing that characterizes this is when you look at, say, some of the regulatory, say, clarity or better yet, regulatory comfort that we're seeing, certainly out of the U.S., but we've also seen advances with MiCA and the FCA as well, including, say, some advances in Hong Kong. All these things really are pointing, say, to increased growth. As these new participants come into the space, there's increased need for more risk management tools, such as those tools that are offered by CME Group, right? So we're seeing more of interest and more of a push for regulated products, reliable products, liquid products, such as those as the ones that we offer. And incidentally, just because of some of this regulatory comfort that we've seen this year, we've been able to launch 2 additional futures contracts. First futures contracts that we launched was 2017. 4 years later, we launched Ether in 2021. Took us another 4 years to finally launch Solana. And now we have two cryptocurrency contracts or futures contracts that we launched this year. And that's really all because of those factors: maturity, adoption, and that regulatory comfort.
Yeah, I mean, fully agree with what has been already said. I think the store of value idea has now started to be accepted also by institutional investors. We see more and more products where Bitcoin is a component. I mean, we see like all these like Bitcoin treasury company, issuing very interesting debt products on the market. We see a lot of like strategy around options to capture like a yield on these, like for example, strategy equities, but as well Bitcoin as a pristine collateral. So we are seeing in Switzerland, but also outside Switzerland, more and more banks that are offering Bitcoin-backed loans. So they are now understanding that Bitcoin can be seen as an excellent collateral asset.
I would like to double down on what Giovanni said on the rise of new products and the new era of crypto. And one of the ones that have for sure taken a lead is staking across the whole spectrum. Martin, I do want to hear your thoughts on this. What are the key components of that optimal portfolio around staking strategies, and how does investors assess risk versus reward when selecting which assets and why?
Yeah, maybe we should clarify when I talk about staking, I mean protocol staking. Yeah, so it's not about lending or doing some DeFi stuff. It's still, when it comes to strategy, it's still very focused on investing in a single token. Yeah, so ETH leads here, then maybe followed by Solana, and then it's interesting that we also see some traction with Avalanche recently. So in the last 2 years, it was mainly about having the infrastructure in place, yeah, staking as a service providers, OFA compliant relays and all that stuff. But it's really missing. So we do a staking benchmark to measure the total return, for example, of Ethereum. But it's almost not used, right? And I wonder how people assess their staking performance without any benchmark, because it's not like a dividend where you know, okay, UBS paid a certain amount of dividend and that's your thing. Everybody has basically a different staking rate depending on are you doing it as a hobbyist or are you outsourcing it as to a staking as a service provider? And I think that's really a basic component. And my hope is that, I mean, some are doing that in Europe, but my hope is, and I'd like to hear your opinion in the US, we finally will get that. But I think the SEC doesn't require that necessarily. But I think as soon as one ETF provider starts providing more transparency, that should also include a total return perspective and also what kind of distributions are made according to a fair benchmark. And I don't know if I'm mistaken there, if you are seeing the same, or if it's still a dormant thing and everybody's still relying just on a plain vanilla price. Yeah.
Yeah, no, I think that we are beginning to have a lot more conversation, say, around staking, right? Particularly as it relates to both Ether and our SOL products. It's still relatively early, but I do believe, though, that if staking is allowed on those US-based ETFs, I think that it will sort of like bring a market for products to hedge. Think of it as, in the equity space where you've got index-based equity products, right? But then with those index-based equity products, you also have dividend futures, for example, right? So those futures then allow those market participants to hedge, say, that dividend risk that they face. And I would imagine that something similar could happen, say, if staking does get approved for those ETFs, where there's going to be more need for those types of risk management tools to hedge that portion of the portfolio.
And about BTC lending, like lending specifically, Paolo, what have you experienced in the last few months, and what is the appetite for such?
Yeah, I think probably in the last year we really seen like a big shift in the market. I mean, lending is nothing new. It's a strategy that banks are already familiar with Lombard loans and other type of strategies. But unfortunately, in the past, we've seen like some players that they enter into this market and they were not really putting good practice around lending. So we saw, unfortunately, a lot of company, losing a lot of, especially on retail, for retails, like a lot of Bitcoins. So I think nowadays we have like more institutional players entering the space. They understand the risk framework. They understand the fact that replication is a risk. They understand that they have to rely on qualified custodian to store the collateral, and if you understand the risk and if you are putting proper control around the risk, it's a very appealing investment. So we see more and more banks in Switzerland, but also in Europe, started to offer to their clients Bitcoin-backed loans. We see a lot of lenders that are entering the space. I mean, rates are still pretty high, I would say, but I think it's just a matter of time that they will probably go down, and we will probably reach a similar rate that we have in traditional Lombard loans.
And thank you, Paolo. I think we have covered already some of the major products that are taking the lead, and from a service provider perspective, we have shared our views. Now I would like to switch to allocators, and specifically the ones most difficult for many, which are the family office and multifamily offices. Most of them have tread carefully. They have a quiet but secure stance, in my opinion, to digital assets, and they are allocating. So I would like to ask all of you, what is your experience so far? Have you seen a growing interest? In which products there are more interest on? And do you see this allocation trend increasing? And why? Quentin?
Yes. So I would say that a few years ago, it was taking a risk to do an allocation to crypto. And today, when you enter and discuss with a family office, for instance, you are now having a more valid conversation where, in fact, you're speaking of finding solution to have a compliant investment structure for them, to allow them to access the asset without taking risk or without managing the risk if they ask a manager to do that for them. So to answer your question, yes, we have more and more discussion around it, but there are still kind of slowness in some of them to enter the space. But it's more a matter of when now than if they are going to do it. So we are quite bullish on the fact that crypto is still going to continue to attract some decent flow of money. We have made a study recently. In Europe, you have approximately 10,000 billion of assets under management in alternative investment fund. We have only 50-60 in Europe, which is allocated to crypto. We strongly believe that in the 4 or 5 years to come, crypto is going to attract approximately 500 billion of investment. So yeah, the market is looking promising.
I can speak more for the ETP ETF market because that's primarily our clients there. So by far it's still focused on single token products, but what we see, there is a shift towards more baskets. What do I mean with baskets? So that could be a top 5, top 10, even broader basket, similar to what you have in the TradFi world with the S&P 500, for example. And it makes sense because, especially in TradFi, people know what Bitcoin is, they know what money is, they get the digital gold narrative, but they're already struggling with Ethereum. And if you're honest, it's not a safe bet anymore to say, after Bitcoin, I definitely need Ethereum. Maybe it's Solana. Others are speculating maybe already in Sui. And so for most of the normal investor base who just want to make an allocation, I think that's the better product. The problem is, however, that it's not easy from a regulatory standpoint. So we can do a lot of interesting indexes, but it has to be approved from the exchanges. Now that's opening up. So we have new etc. rules. You can do much more interesting things. Also, the SIX exchange opened up. But of course, it's a completely different picture in the US, where you still have just Bitcoin and Ethereum ETF. Now that will be changing, and my hope is that you also get some quantifiable rules, because I can't imagine that somebody at the SEC is sitting there and thinking about a Pengu ETF or about Shiba Inu versus Doge, right? That doesn't make sense at all. Yeah, so, and I think with that market structure, Bill, my hope is that we get these broader baskets, we get sectors, yeah, so that you can bet on DeFi, you can bet on AI and other things. Right now, it's focused on this Bitcoin, Ethereum stuff.
Yeah, for sure. The story, has been Bitcoin, right? And when you look at just its relative outperformance and how it's grown in terms of market capitalization, where now Bitcoin represents north of 60%, say, of cryptocurrency market cap, right? So I think when you look at family offices, the interest is still there. And I remember talking to some family offices, way back when we introduced Bitcoin futures in 2017, and they were already thinking about the space. But I think that Bitcoin does continue to still be that story. And for family offices now, it's also about, well, how do I, say, continue to increase maybe the yield for those holdings that I have? So we're seeing, having more conversations, say, around other strategies that they can use, like covered call writing, maybe deploying, say, some leverage or probably, say, looking to benefit from basis trading as well.
Yeah, I fully agree. I think I'm talking more about like the Swiss market. I think there is a big gap of what family offices are saying and what they are doing. I believe most of them are already active. They're already buying. They're already allocating capitals. Of course, they are still concerned. They still have some concern. They still have some potential concern around the reputational risk. But I think it's, it was discussed this morning in another panel. The infrastructure is changing. These players, they have the possibility to invest in products that they're already familiar with. They're familiar about the legal framework. They're familiar about the risk. So, as you already said, it's just a matter of time where we will see like more and more investors coming in.
Excellent. Thank you all for those insights. And I would love also to touch on, for me, probably some of the most interesting projects out there, and that's derivatives. For this, I wouldn't find a better speaker to respond than CME Group, right? And I would like to understand, Giovanni, from your perspective, how derivative-based strategies has been rising, what is the demand you're seeing from prop shops, hedge funds across the world, not only Switzerland, and how do you see this space evolving?
Yeah, no, thank you for that question. I think when you look at the space, right, when we first launched, we attracted some of the traditional, say, liquidity providers. So these were firms, for example, that were already active within, say, the CME space, and they were just providing liquidity for these new futures contracts. But we started then very early on attracting some of the crypto native platforms. Think of some of the maybe a few less these days, but some of the early, say, crypto lending platforms were active in our space. We started to attract some of the crypto-focused funds. And then I'd say really beginning in earnest in the summer of 2020, we really started seeing some more, say, of those traditional hedge funds enter the space, right? And then we had the launch of futures-based ETFs that brought new participants in. We started seeing, a rally in the price of, Bitcoin in particular. So we launched micro-sized contracts at 1/10 of a Bitcoin, whereas our large Bitcoin contract is 5 Bitcoin. So that then started attracting more retail, or our contracts became a little bit more accessible for retail participants. And these smaller contracts actually also helped institutions with fine-tuning exposures as well. Once the spot ETFs launched last year, that's when we really started to see some of those traditional hedge funds really step into the market, because now for the first time, those hedge funds that couldn't benefit, say, from relative value plays like cash and carry, basis trading, now with the ETF, they could enter that space. So they could easily buy the ETF, sell the futures contracts, and last year that basis trade was north of 20%. It's come down a bit, but that still remains a popular strategy. But I'd say what's attracting institutions into our space, we offer regulated contracts. All our contracts are cash settled, reliability in our market, and then really the sheer liquidity of what our markets are trading. As I mentioned in my intro, we're trading upwards of about $10 billion a day. If you compare that number to what's traded on some of the, spot exchanges, centralized exchanges, or compare it even to the ETFs, we do have market-leading liquidity where we're out-trading those markets by about three times, right? Because particularly when you look at the ETF market in particular, the futures contracts really become the benchmark or the foundation on which those products are built, because it allows liquidity providers to access liquidity very quickly, lock in a price, and then work an order, say in the spot market, to deliver spot to the particular, say, ETF issuer. The other thing I think that's attractive about our markets is really the financial safeguards that we offer. You know, we've been doing this for a long time, and if you're in our market, you're already familiar, say, with CME, you already have certain financial safeguards that you're also going to benefit with on our crypto side. And anybody new that comes into our space is benefiting from, is able, say, to benefit from those same safeguards that all other participants in our space benefit from.
Excellent, thank you, Giovanni, and it's wonderful to hear your perspective and seeing the growth of CME right in the last few months. It's been quite a huge rise. And before we move into the last question, just wanted to open quickly the floor to any of you who might have questions on the topic. I do see a few familiar faces, trading teams and asset managers around. So if you do have a question, feel free to do so. If not, we're going to move towards the last question of today's panel. Any question? Please.
Question for Paolo, actually. You say you do backlining and lending against Bitcoin. How do you handle the currency arbitrage? Might be over-collateralized on the USD, but under-collateralized on the Swiss franc?
So normally, the majority of the volume is for US dollar denominated loans. So we don't have to deal with FX risk. I think demand for Swiss franc or euro denominated loans is still relatively low.
Any other question on digital asset strategies? Anything that you particularly would like to know from the speakers today, please?
I can take this one. From crypto native people, it's clear it's DeFi. From traditional finance player, it's not DeFi. It's more looking at getting the funding rate by shorting the asset and having it, and just getting the funding rate. Because the problem for traditional finance player is that to access DeFi, it means that you are going to pool your asset with people you don't know, people you can't KYC, and that's an issue because you're even if you KYC the people who enter the pool and you monitor them, you are not sure that someone is not entering afterwards and not bringing a tainted crypto asset, and it's still an issue. We start to see some solution where we use a segregated vault or vault where thanks to smart contracts they can be accessed only by a white-listed, white-label person, and we are really eager to promote this solution for traditional finance player, because obviously it brings a lot of interest for generating some yield on crypto assets which are owned by, for instance, an investment fund.
Does that respond to the question? Yeah, absolutely. Great. Any other question? Great. If not, I would like to wrap up here just because we have just 4 minutes left. And I would like to ask you, what is the best way to connect with you, with your companies, with your BD teams? Are you going to be around today at the end of the afternoon, Paolo? Yeah,
I will be around. Otherwise, berglinde.com. That's our website.
Excellent.
I'll be around as well. I hear that there's a boat cruise happening today, so we can chat there.
Lovely.
I have a next panel at the Audi media room on the Coinbase 50 that could be interesting to some of the people here.
I will stay until 4, but please connect with me and we can discuss next week about any question you might have.
Excellent. Thank you all. It's time to draw the curtains, but huge amount of applauses for all of us.